Is the crypto market entering a lost decade? According to Ben Cowen, we're currently 53% below the fair value trendline, a situation mirroring the bleakness of late 2019. He warns that the total market cap could continue to bleed down towards $1.5 trillion. But DataDash argues that this kind of macro fear is just noise, designed to shake you out. He points out how the worst FTX news hit at the exact market bottom, and that we should ignore narratives and focus on the charts. So what do the charts say? Crypto Jebb identifies a critical crossroads for Bitcoin, targeting an $80,000 rally if it breaks above $70,000. However, if it fails, he sees a probable drop to the 200-week moving average around $58,000. Echoing this, CryptoRover sees Bitcoin consolidating in a tight triangle, also targeting a $57,000 breakdown level. He notes its surprising resilience to global chaos, but has his own buy orders waiting in that same low range. So is a macro-driven crash imminent, or will the technicals hold? We're breaking it all down. In the latest video from the Ben Cowen channel, the discussion centers on the crypto market's current state, which is sitting about 53% below its fair value logarithmic regression line. A key point made is that the market never reached a durable overvaluation this past cycle, because altcoins didn't really participate in the bull market, much like what happened in 2019. This has led to a situation that feels like a prolonged downturn, mirroring the late 2019 period, but now overlapping with the standard midterm year bear market in 2026. The big question now is whether the total market cap, currently around $2.3 trillion, will continue to bleed down towards the lower regression band at about $1.5 trillion. Bitcoin's performance is seen as the primary driver. If it keeps falling, it's almost certain to drag the rest of the market down with it. The video brings up the sobering idea of a lost decade for crypto, noting that the asset class is at the same valuation it was 5 years ago. This doesn't mean crypto is broken, but rather that it's maturing within a tough macroeconomic environment it hasn't faced before. The outlook is for continued bearish conditions with a potential market low later this year, though the long-term view remains that the asset class could eventually reach a $10 trillion valuation. Ben Cowen's analysis of a potential lost decade for crypto, where valuations stagnate for years, feels particularly relevant in the current market. As of early March 2026, sentiment is in a state of extreme fear, with the fear and greed index hovering around 10. This aligns with Cowen's view of a prolonged downturn. The market is grappling with significant macroeconomic pressures, including geopolitical tensions and uncertainty around the Federal Reserve's interest rate policy. While the Fed executed several rate cuts in 2025, there's considerable debate on whether more will come in 2026, leaving risk assets like crypto in a precarious position. Cowen's point about the 4-year cycle losing its dominance is echoed by other analysts, with firms like Grayscale suggesting that steady institutional capital is replacing retail-driven speculation as the primary market driver. Indeed, reports indicate that institutional adoption has continued to accelerate through the downturn, which could provide a stabilizing floor that didn't exist in previous cycles. The focus on upcoming ISM manufacturing data mentioned in the video is also timely, as a strong report could influence the Fed's decisions and impact market liquidity. Ultimately, the market appears to be at a crossroads, caught between bearish macro headwinds and bullish long-term adoption trends. In the latest video from DataDash, the hot topic is whether Bitcoin's price is being manipulated or just following technical patterns. There's a lot of chatter on social media blaming a firm called Jane Street for a supposed daily 10 a.m. Bitcoin dump. The host, Paul Sampson, takes a step back from all the noise and looks at it from a pure trader's perspective. He argues that news and narratives often just show up after a big price move to explain what already happened, creating fear and emotional reactions. He draws a parallel to the FTX collapse, where the worst news hit right at the market bottom, scaring everyone out just before Bitcoin started a massive multi-year rally from around $15,000. Paul emphasizes that he ignores these news catalysts and focuses entirely on the charts. He explains that the 10 a.m. time frame isn't some conspiracy. It's simply when the New York market opens, bringing a surge of volatility. Since Bitcoin has been in a downtrend, it's natural to see downward moves during this high-volume period. He even shows how a recent technical setup he was tracking led to a sharp rally during that same 10 a.m. slot, going against the manipulation theory. The core message is to stop chasing headlines and instead manage risk based on the market structure. The video's focus on technicals over manipulation narratives is a classic trader's viewpoint, and it holds up well against the current market backdrop. The Jane Street rumors have indeed been swirling, fueled by a lawsuit from Terraform Labs alleging insider trading during the 2022 Terra/Luna collapse. However, many market experts are pushing back, arguing that pinning Bitcoin's entire price action on one firm is an oversimplification. As a former Wall Street market maker cited by TradingView explained, while firms can influence intraday prices to trigger stop orders, structurally holding down an asset as large as Bitcoin for months is a different story. The more likely reason for recent price struggles, according to on-chain analysts, is significant selling from long-term holders, not a coordinated suppression campaign. This aligns with the video's core theme that price follows liquidity and market structure. The current environment, as noted by reports from Forbes and Coinbase, is one of increasing institutional influence. While this brings more capital, it also introduces more sophisticated trading strategies, which can easily be misinterpreted by retail as manipulation. The 10 a.m. dump is more likely a reflection of institutional trading activity around the U.S. market open, a period of natural price discovery and high volume, rather than a sinister plot. In the latest video from the Crypto Jebb channel, the focus is squarely on Bitcoin's next potential move. Jebb kicks things off by discussing the recent news that Jane Street, a major market player, has apparently stopped its market manipulation that was pushing prices down. But the big question is, does this mean an uptrend is about to start? The analysis centers on Elliott wave theory, looking for a four-wave bounce. There are two main paths Bitcoin could take. The bullish route involves a rally up towards $80,000, but this would require Bitcoin to decisively break above the $70,000 to $71,000 range. On the other hand, if Bitcoin fails to reclaim that level and continues to trade below the 200-week exponential moving average, it's likely headed for a drop to the 200-week simple moving average, which sits around $58,000. Jebb notes that the weekly RSI is extremely low, suggesting a significant bounce is probable in the coming weeks, regardless of which scenario plays out first. Looking further ahead, he shares a long-term outlook, predicting the next bull market could take Bitcoin to a new all-time high somewhere between $180,000 and $250,000, framing the current price as a great entry point for a long-term position. Jebb's technical analysis presents a clear crossroads for Bitcoin, hinging on the $70,000 level. The narrative around Jane Street's alleged manipulation halting is compelling and has certainly been a hot topic across social media, with many traders linking the recent price rebound to the firm's legal troubles with Terraform Labs. However, some analysts remain unconvinced, arguing the 10 a.m. dump pattern isn't statistically significant and that it's more likely part of a complex, direction-neutral arbitrage strategy. While Jebb's Elliott wave targets are plausible, the broader market is also being influenced by macroeconomic factors. Recent reports show some analysts, like Henrik Zeberg, are calling for a rally to the $110,000 to $120,000 range as soon as this month, driven by ETF inflows and a return of risk-on appetite in global markets. This creates a conflicting picture. Jebb's analysis points to a potential final drop to the high $50,000s, while macro sentiment suggests institutional flows could prevent such a deep correction. The resolution likely depends on whether the technical picture or the ETF-driven demand proves to be the stronger force in the near term. In the latest video from the CryptoRover channel, the host points out that Bitcoin is currently consolidating within a very important symmetrical triangle. Despite a chaotic last 48 hours in the world, including escalating tensions in the Middle East, Bitcoin has shown remarkable strength, holding steady around $66,000 to $67,000. It's interesting to see that even the U.S. pre-market barely reacted to the global news. This resilience could mean one of two things. Either the market had already anticipated and priced in these events, or a bigger reaction could still be coming, possibly when the stock market opens. This speaker is sticking to his strategy, keeping buy orders open in the $56,000 to $61,000 range, which he considers a technically significant area for accumulation. A breakout from the current pattern could send Bitcoin surging towards $76,000, while a breakdown might lead it down to around $57,000. A recent bearish crossover on the 3-day chart also suggests a market bottom could form within the next month, adding another layer to the current market puzzle. The video's observation about Bitcoin's resilience is quite timely, as recent market action has indeed been a tug-of-war between fear and conviction. Over the weekend, news of military actions involving the US, Israel, and Iran sent Bitcoin on a roller coaster ride, initially dipping to around $63,000 before quickly rebounding. This price action supports the video's thesis that the market is surprisingly robust. Some analysts suggest this resilience stems from seller exhaustion, indicating that many of the weak hands have already exited the market. However, the situation remains fluid. While the initial shock seems to have been absorbed, the real test, as noted in the video, will come as traditional markets process the geopolitical developments. Data shows that derivatives traders are hedging their bets, with significant put options stacked at the $60,000 strike price, signaling caution. A crucial factor to watch will be the spot Bitcoin ETF flows. After 5 weeks of outflows, last week saw a significant positive inflow of over $787 million, suggesting renewed institutional interest at these prices. How these flows react to the ongoing global uncertainty will likely dictate Bitcoin's next major move.
So after breaking down 4 different perspectives, what's the final verdict? There's a striking consensus that Bitcoin could see one more significant drop, with most analysts eyeing the high $50,000 range as a critical support and accumulation zone. Where they diverge is on the cause. Is it macro pressure, a predictable technical pattern, or simply market noise that should be ignored? The big question remains whether resilient institutional flows can prevent that dip from happening. Your key takeaway: focus on market structure, not fear. That potential drop represents the strongest point of agreement and the most important level to watch.